How do we get in a situation where, let's say, a relatively risk-averse investor is now thinking, wow, I really should be considering alternative investments?
Going into 2008, it was a very kind of esoteric and shadowy market where it was, categorized by high minimum investments and hard to access. And we've really seen just, I would say, massive growth in the availability of alternative investments for many, many more investors. And so,
there's a few different ways that an investor could access a real estate type investment. For most investors, the easiest way to do so is via publicly traded REITs, either ideally through a mutual fund or an ETF.
key considerations is really understanding what is your risk return trade-off. And so like Jim said, there's 100 different ways you can access the real estate market. It's no different than private credit or structured credit or anything like that. It's same scenarios, understanding what risks are acceptable for your portfolio. So for example, are you willing to trade, say, liquidity?
But talk a little bit, if you would, about bonds and the role that bonds have traditionally played in a typical kind of balanced portfolio, and how they look now.
In a yield-starved world, when you're looking to add yield, or you're trying to chase yield, the only way to add yield to your portfolio is to increase risk.
Do you consider crypto an alternative investment, and how do you advise one of your clients who comes to Plante Moran and says, I really am, dying to get into Bitcoin or Ethereum? How do you evaluate those investments?